We've been talking about, I don't know if it's been a head fake. I mean, it seems like it's been a head fake for me, or not for me, but it seems like it's been a head fake for the equity markets. You have all these sort of cross currents of news over the past 2 weeks, and you heard Roger Ferguson in the last hour. He says, look, the Fed's doing what it's going to do, and we've said that the whole time, and yet the equity market doesn't seem to want to believe it. What do you think?
Well, I think, first of all, it's nice to have seen some stability most recently in the equity markets. I mean, we've chopped around here around these levels, and we've been able to hold on to this 10% rally. And what I think is, I think we can still build upon the rally that we've had and push higher into year end, because to your point, the markets are starting to believe the Fed. And I think this next phase of Fed policy, which is still continuing to hike, getting to 5%, but getting that there at the slower pace, I think that's pretty well digested by the markets. And look, inflation is coming down. We have more and more signs of it. And, we're not going to call for peak inflation because we've done that over and over again and have been wrong. But that inflation print, that doesn't actually change Fed policy. What Fed really wants to see now is the labor market to start to show signs of weakness. And if it does, then what I think the markets will start to sniff out is the end of the tightening cycle. So again, the reason I think we can digest Fed policy and push higher is because it is priced in. The Fed fund futures are pricing in 5% by sometime next year. And if labor market weakness actually appears, then we'll start to jump to conclusions that we might be finally nearing the end of this tightening cycle.
So, from here on out through the end of the year, which is sort of a short-term thing to even say, given that we have less than a month and a half to go. But if we had this conversation about what it looks like a year from now, what do you think the opportunity is for the market?
So first of all, near term, I think if we do continue to build on this rally, I would sort of think about it as a year-end gift to investors, one that you probably want to cash in and not hold on to. And what do I mean by that? Near term, you want to be selling the rallies as we get towards 4,000, 4,100. I still think that's the near-term resistance level. So you want to sell things that probably are not going to work well even a year from now. And the things that I would put into that category are some of the broken leaders. Maybe it's some of the big tech names, which, as you know, they've not kept pace with the market. Maybe it's some of the unprofitable tech companies that relied heavily on valuation expansion. A year from now, even if the Fed starts to ease a little bit, it's off of 5% or higher than that. So again, I don't think it's going to be an environment of massive multiple expansion going forward. The things you want to buy, especially as the S&P dips, let's say, to 3,600, you want to buy things that can compete with a cash yield that's 4 or 5%. And to me, those are dividend-paying stocks, some of which are paying dividends of 4%. I would put energy in that category. So I think you want to have this portfolio of dividend payers and maybe do barbell that with some of the tech companies that do have cash flows, and they're not pandemic plays and they're not broken leaders. So that's how I would approach it for the next year.
How do you think about how folks are going to think about tax losses and tax harvesting come December, and how that may affect buying and selling going into Christmas?
Yeah, I mean, mutual funds have done this already. So I think that's actually a nice thing that's behind us, is there's not this wave of tax selling that has to happen for mutual funds. For individuals, I think it's going to be about balancing, taking some of the gains in some of the positions and offsetting that with some of the losses. So I don't necessarily see that as a big market moving event, because I think it's going to be more squaring of those positions. But again, the other thing that can be constructive into year end is that one of the largest buyers in the market is corporates, and corporates have faded during, buying back their shares during the blackout windows during earnings, but they're now back, and that's going to be the case into year end as well. So even if we see some, individual investors accelerate the tax loss harvesting, I think you have a force that's offsetting that, which is the corporate buyer.